Fed's pivot, a friend or foe? Fed pivot means a reverse in the monetary policy stance by the Federal Reserve. For example, the Federal Reserve started quantitative tightening, thus raising interest rates since March 2022, to curb the rising inflation. The chart depicts the past 6 Federal Reserve pivot points. The 6 points in the chart are the point of time when the U.S. Federal Reserve reversed the course of its monetary policy and broke the trend of interest rate hikes. Interest rates directly affect the lending rate and cost of capital in the market. Historically, rising interest rates have an inverse relationship with stock market returns. As borrowing gets expensive, the expected growth outlook of an economy becomes sluggish. Businesses need capital to fuel growth and expansion, which becomes more expensive after interest rates hike. Thus, this is said to be one of the possible explanations for the weak performance of stock markets during interest rates hike. The table shows the data of the one-year return of the S&P 500 after the Fed's pivot. As we can see, the markets reacted extremely positively to Fed's pivot during 1982-83, 1984-85, 1989-90 and 1995-93. The annual return of the S&P 500 was 51.35%, 13.85%, 12.58% and 37.23% respectively. Thus, indicating that in the pre-2000s, the markets repeatedly reacted extremely positively to reverse the monetary policy. Although the data from the post-2000s suggests that the market didn't welcome the Fed's interest rate pivots as they did previously. We have witnessed a change of trend from the 2000s, where the markets have fallen significantly for the next 1 year in reaction to the pivot by the Fed. The interest has soared considerably from the lows in USA and other developed countries in order to counter inflation. The USA's central bank, the Federal Reserve, aims to bring down inflation to its original target of sub-2% levels from the peak of 9% in 2022. Thus, the Fed has continued a hawkish stance and the interest rates have risen aggressively, bleeding the market for the past year. People are expecting a less aggressive stance from the Fed now, as the inflation data has suggested a small downward trend, but not something significant has been promised by the Fed in the FOMC meeting. Thus, the whole market is expecting a less aggressive rate hike, something lower than 75 basis points, 1 basis point equals 0.01%, from the Federal Reserve, believing that the market will finally bottom. But the new trend which started in the 2000s shows the otherwise. If the new trend continues, then the market will plummet more in reaction to the event of the Fed's pivot, which might extend the bear market longer than expected. Therefore, this could be a poison pill for the market disguised as a sweet.